Hi, it's Valerie from VMCPA, here to talk to you today about federal quarterly estimated tax payments. Kind of a mouthful, and they certainly are pesky to deal with. But if you are a freelancer, a gig worker, a sole proprietor, small business owner, maybe you are a shareholder in an S corporation or a partner in a partnership, even the beneficiary of a trust, or you have some investments in a brokerage account. If you have any taxable income that does not have taxes withheld from it, you need to be paying attention to federal quarterly estimated tax payments. Or even if you have income that doesn't have enough taxes withheld from it. I've seen that on Social Security income or unemployment benefits, retirement plan distributions. If you have any of those and you don't have enough taxes withheld, you need to be paying attention to federal quarterly estimated tax payments. Why? Because here in the United States, we have a pay-as-you-go income tax system. That means that you pay in the tax as you earn the income throughout the year. Yes, we file one tax return due on April 15th, but that's just kind of a reconciliation. That's not when all of the taxes are due. The taxes are due throughout the year when you earn the income. So let's say you have a regular job and every paycheck you get paid by the employer, and then the employer holds back taxes. They withhold taxes from your paycheck and they send those off to the IRS and the Social Security Administration under your Social Security number, and they give you credit for those taxes when you file your tax return on April 15th. And those taxes are withheld from every paycheck. Pay as you go. But let's say you're a freelance graphic designer and you finish a job, you send an invoice to your client pays you, and then what? Nothing. It's on you to make those tax payments, and when you do, they're called federal quarterly estimated tax payments. So that's the why. In today's video, we're going to talk about how much, how, and when. One side note before we get started, the federal quarterly estimated tax payment requirements for farmers and fishermen are somewhat relaxed. Their amounts due and the due dates are different than the rest of us, and I will not be discussing those in today's video. So with that, let's get started. When it comes to federal quarterly estimated tax payments, there are two objectives. One is to avoid penalties. You can incur IRS penalties for not paying in the right amount and for not paying at the right time. The second is to avoid a big cash scramble on April 15th. If you haven't been paying in as you go, suddenly you're going to have a big tax bill on April 15th. You can smooth out your cash flow if you make payments as you go throughout the year. Which one should you focus on? I highly recommend that you focus on avoiding the tax penalties by making payments of at least as much as is required to avoid those penalties. And we'll talk about the two methods for avoiding penalties in just a moment. After you've paid in those minimum amounts, then you can contemplate any additional amounts that you might want to make to not have a big tax bill on April 15th. The difference between the minimum amount required to avoid those penalties and your total tax bill for the year, well, you will eventually have to pay that amount, but when you pay it is optional. It's kind of a style choice. You can either set that money aside, maybe in a savings account, and then pay it on April 15th, or you can just pay it in as you go with your regular estimated tax payments that you're making in order to avoid those penalties. Now, when it comes to avoiding penalties, there are two methods. There is the look-back method, sometimes called the safe harbor method. This is definitely the easier method, but sometimes it's not called for. And then there's the current year method, which is often more complex, but sometimes more appropriate. We'll talk about which method is the best to use a little bit later. For now, let's take a look at the first method, the look-back method. This method starts with a copy of your last year's tax return in hand. You'll need two numbers from this form: the adjusted gross income from line 11 and the total tax from line 24. The line numbers I'm referring to here are on the 2020 tax forms. They will change as the years go by. So if the amount on line 11 is above $150,000, we're going to take the amount on line 24, the total tax number, and multiply it by 1.1. In other words, we're looking for 110% of last year's total tax. If the amount on line 11 is under $150,000, we're just going to take that total tax line as it is. In other words, we're looking for 100% of last year's total tax. Then we're going to take our resulting total tax and we'll divide that number by 4. That is the amount we need to cover each quarter. Now, we'll talk about the method for making those payments later and when those payments are due later. But for now, let's cement this look-back method with a couple of examples first. Let's look at Jane as an example first. We're looking here back to her 2020 income tax return. That's her prior year return. And our eyes are on line 11. And here we see her adjusted gross income is $72,348. I'm using Excel for this. You don't have to use Excel at all. You could use pencil and paper, a calculator, your fingers, your brain, whatever works for you. So her AGI, as we tax nerds call it, or adjusted gross income, is $72,348. Definitely below the $150,000 threshold. So let's take a look at her tax. It's $19,008, as you can see on line 24. Like we said, her adjusted gross income, AGI, was below $150,000. So we don't do any manipulation to that total tax. We just leave it at 100% of its number, $19,004. Then we take that number and divide it by 4. Every quarter, Jane, in order to avoid penalties, needs to get in $4,752 to the IRS. She can do that in a number of ways. First, we look if she has any taxes withheld from any earnings. Does she have a job, a pension, Social Security income, anything like that? Well, in this example, no. So for Jane, we're just simply taking her total her total obligation each quarter, and that's how much she's going to pay in. Like I said, we'll talk a little bit later about how she might pay that in. But what we see here is each quarter, Jane needs to make sure that the IRS gets $4,752 so that she doesn't incur any estimated tax penalties for the 2021 tax year. Let's take a look at Marcy. Marcy has a slightly different situation. Her adjusted gross income, as you can see here on line 11, is $170,000. That is definitely above the $150,000 threshold. So let's drop down here to look at her total tax on line 24, which is $30,104. But because her adjusted gross income for 2020 was above $150,000, we need to take that number and multiply it by 1.1 to arrive at 110% of her 2020 total tax. So I'm going to take that total number that we just calculated and divide it by 4. That means Marcy needs to pay into the IRS $8,279 each quarter. Now, Marcy is an employee, so she has taxes withheld from her paycheck. So she's going to go grab her pay stub and she's going to look at the taxes that were withheld this quarter. And I'm just making up the numbers here. When Marcy looks for this quarter that we're concerned about, she had $5,000 withheld from her paycheck. So Marcy needs to cover out of her own pocket $3,279. That's how much she needs to pay in quarterly estimated tax payments this quarter. Now, the next quarter, she may look at the withholding from her wages and see that a slightly different amount was withheld. So she'll subtract that amount from the total obligation of $8,279 to arrive at the amount she should pay for that particular quarter. Okay, so that's the look back method, and you can see that it's relatively straightforward. The current year method is more complex. So roll with me here. First off, it's more complex because, well, it's just more work. It requires that you gather your current year information, whatever you have about your income and deductions so far for the year. And then using that information, you mock up a current year tax return. And with that mock up, you estimate your current year tax burden. So let's take the first quarter. You're sitting here at the end of March and you've gathered your first quarter's income and deductions and the numbers that might factor into credits for the year. And next, you have to project those out to the full year. You assume that every subsequent quarter will behave the same as the first quarter. So you take those first quarter numbers and you multiply them by 4 to get a full year. The technical term for this is annualizing. So you put those full year projected numbers into your tax software or whatever tool you might be using to mock up a tax return. And actually, this leads me to the second reason why this method is complex. And that is that you actually need a tool to mock up the tax return. Now, maybe your consumer level tax software has a tool for this. I'm not sure. You might use Excel, but I'll tell you, there's so many moving parts. It's hard to get Excel to do the job for you. You might be able to find a calculator online. I know there are some decent ones out there. Just, buyer beware. Look closely, make sure it's accurate. And the other alternative, and this is not meant to upsell you on any services, but this is often the time when folks reach out to a tax professional because we're the ones who have the tax projection software that can help us mock up the tax returns in these situations. In any case, you take those accumulated annualized numbers for the year and you use them to prepare a mock tax return for the year. Now, that mock tax return will punch out a number, a tax obligation that represents a full year's worth of tax. So the next step is for you to take that number and roll it back into the quarter that you're working in. So we're talking right now about the first quarter. So you would take the tax number that you had developed in your mock tax return and divide it by 4 to get the amount that you need to cover in the first quarter of the year. So you take that number and just like we did before, you subtract from it any other taxes that you've paid in. Maybe you have withholdings from some other earnings, or maybe you rolled over some taxes from a prior year's overpayment into this year. Anything like that. Then you would subtract that from the amount you expect to owe for that quarter, and that's how much you would pay in. Now, depending on what quarter we're talking about, things can get even a little more complicated. Let's pretend we are in September. September 15th is the due date there. And we are then going to look back at the income and deductions and credits that have been bouncing around for the first 8 months of the year through the end of August. And we take those numbers and we annualize them out to the full year. So to do that, we have to divide by 8 and multiply by 12. So we're taking those first 8 months of the year and pretending that they're going to continue on the same pace and annualize those numbers. So with that, I will mock up a tax return and using whatever software tool I have, and that will spit out a tax obligation number that is covering the entire year. So then I roll that back to the August 31st number by doing the opposite of what I did with the input numbers. So this time I multiply by 8 and divide by 12. And so that will get me back to the August 31st number. Now, that is a year-to-date number. It is the amount of taxes that you need to cover for the first whole 8 months of the year. Now, from that, you would subtract any taxes that have already been paid in. So taxes paid for the first quarter, taxes paid for the second quarter, any taxes that you've had withheld from earnings like jobs and retirement plan distributions, anything that we've talked about before, And also maybe you've had some overpayments from prior years applied into this year. You would subtract all those out, and then whatever's left over is what you would pay on September 15th. Whew, that's a lot. So to break it down, let us take an example. We'll walk it through, and that might make it a little easier to understand. So let's put some numbers to this and we'll try to make some sense of it. I came up with this taxpayer, Katie. Now, she has income from various sources. She has wages, interest income, dividends, capital gains, and is also a shareholder in an S corporation. So let's walk through each of those. She gathered together her materials and she told us that through August 31st, based on her pay stubs, she had wages of $121,950. So if we divide that by 8 and multiply by 12, we get to $182,924. Similarly, looking at her bank statements, she sees $50 of interest income so far and up through August 31st. So divide by 8, multiply by 12, and we get to $75. Similarly, looking at her brokerage statements, she sees $200 worth of dividends, divide by 8, multiply by 12, and we get to $300. Now, for capital gains, sometimes those are a little hard to predict or can be uneven throughout the year. So instead of looking at the year-to-date numbers, through a conversation with Katie, we developed an estimate that for the entire year, she would have $4,000 of capital gains. So we just put that number in the total annual column. Going down for S corporation income year to date, $17,000. That comes from the net bottom line number of the S corporation books, and that's a whole other project. You would want to be in conversation with the accountants and bookkeepers running the S corporation, and from that you could get a number that you would plug into here, and we would take that number divided by 8, multiplied by 12 to get the annual figure here. So the income summed up here, $212,799. From that, we're subtracting her health insurance because as a corporation owner, she gets to enjoy the self-employed health insurance deduction, and $7,500 so far. So that annualizes to $11,250. That gets us to her adjusted gross income projected for 2021. And from that, we're subtracting Schedule A itemized deductions. Again, we did a similar thing here for Katie. Rather than looking at all of the year-to-date numbers, we figure these ones can be derived through conversation, through looking at last year's numbers, and figuring out what expectations we have for 2021. And we came up with a number of $23,000 for the year. So we just put that in the total annual column. Now, I'm not going to talk about the qualified business income deduction today. That's a whole other topic, but we figured out here that Katie does not qualify for it. So we arrive at taxable income with simply subtracting the $23,000 of Schedule A itemized deductions from her adjusted gross income. Now, I took all of these numbers and I put them out into a tax projection software tool that I'm not going to show you today. That's not the point of today's video, but out of that tax projection software, we came up with a tax number for the entire year, estimated number, projected number of $37,420. Katie doesn't have any credits applied to this. She doesn't have any child tax credits or other things going on. So $37,420 is the estimated entire obligation for the year that she's going to have to cover. Now, we're just concerned with January 1st through August 31st of this year. So we're going to roll back that total number down to August 31st. And we do that by dividing the number by 12 and multiplying by 8. Taking it back to August 31st, we land at $24,947. And from this number that covers those full 8 months, we're going to subtract all of the taxes that have been paid up through those 8 months. She had a refund of $300 rolled forward from last year, from 2020. And then she's had $15,500 of taxes withheld from her paycheck. We can see that on her pay stubs. In the first quarter, she made a payment of $3,000. In the second quarter, she made a payment of $2,500. So subtracting all of that, we arrive at amount due on September 15th of $3,647. So there you have it. Now you understand why this is the more complex method. And you can see why I might recommend not using this method and instead using the prior year look back method to make sure that you have enough paid in to avoid IRS penalties. Now, why might you want to use this method instead? You might want to use this method when your income is fluctuating a whole lot or when your income is going down. You see, when you use the look back method, it is based on the prior year. So if your income is going down and you use last year's numbers, yeah, you'll avoid penalties, but you will have paid in too much. You will have a big old refund when you file your tax return on April 15th. Now, that's not the end of the world, but I've seen extreme examples where maybe in your prior year you had a big sale. You sold a business or a big asset, your rental property, something like that, and you had a big gain that year. If you use that year as your base year, and then the next year your income is much lower, it's going to be really painful to come up with all of those taxes to pay in each quarter based on the prior year. So instead, we would use the current year method. Similarly, we're going to use the current year method in somebody whose income is fluctuating a whole lot. You know, maybe they're starting out in a new business and every quarter is a little bit different, or maybe those first few years sputter. You know, they have good times and bad times until they find their feet. And in that case, the current year method is recommended because it gets you a bit closer to the real number. So, a little side note before we leave the topic of current year method. Now, when you use this method, technically you're only required to pay in 90% of the current year taxes. But as you saw when we walked it through, that calculation is full of estimates. We're making best guesses and doing some good work, but we don't really know if we've landed on the right tax number, particularly because sometimes tax law changes in the middle of the year or even after the year retroactively, so we may not always get it right. For that reason, I recommend that you pay in at least 100% of the projected number, or maybe even round up so that you have a good buffer and you can be more likely to avoid those penalties using the current year method. Now, how do you pay in those taxes? There are a few ways, of course. IRS Direct Pay is a good way. It's online on the IRS website. You can use EFTPS, the Electronic Federal Tax Payment System. EFTPS is a little bit older, but it's more thorough. It allows you to schedule payments in advance, and you can look up the history of your payments. The only trick when signing up for an EFTPS account, when you do, it's really slick online, and then they send you a code. They mail you a code, and it can take like 10 plus days to get that code in the mail. So don't sign up for EFTPS at the last minute. You need to do that well in advance to leave you time to schedule a payment before the due date. You can also, of course, mail in a check. If you do, be sure to put the tax year, the form, and your social security number on that check. You can also use the IRS To Go app if you're a smartphone user. Here's a few Q&A, a little bit of a catch-all before we go. I wanted to grab a few more topics to share with you before we sign off. First of all, what form is used to calculate the estimated tax payment penalties? Well, with any luck, you won't be using this form because you will have paid in enough to avoid all the penalties. But if you need to check if you've paid in enough, or if you, in fact, do owe some penalties, you would use Form 2210. Now, you can file this form. It is rather complex. Or you can let the IRS do it for you. If you file your tax return without the form and you do owe penalties, the IRS will send you a letter and say, "Dear taxpayer, we've calculated these estimated tax payment penalties and please mail in your payment."
Do I really need to pay federal quarterly estimated tax payments? Well, maybe not. If your total tax for the year minus taxes withheld from earnings is less than $1,000, there's no penalty. You're good to go. That is why it's good to make sure your W-4 at your job is filled out correctly. If you have enough withheld from your pay, you may not need to worry about this at all. Also, I've had some clients say, "I just don't want to deal with it. I'd rather pay the IRS some penalties than pay a tax pro to help me, because when I pay penalties, I save myself time and effort." And, they're right. It's not like you're going to go to jail for incurring estimated tax payment penalties. It's a perfectly reasonable choice to make.
What are the due dates of the quarterly estimated tax payments? Well, the first one for the first quarter of the year, April 15th. Familiar date, right? It's a busy time of year. That's when you'll be filing last year's tax return and making any payments on last year to finish paying up for that year. So you could have a lot of cash that you need to come up with for that year or at that time on April 15th. The next payment is due June 15th. Now, that's not at the end of the second quarter. The second quarter doesn't end until June 30th, and you would think that the payment would be due on July 15th. But no, it's due June 15th. Similarly, the next quarter is earlier than you think. You heard me talk about September 15th earlier. That's the due date for the third quarter. So you would think that it would be October 15th because the third quarter ends on September 30th. Then October 15th would be 2 weeks after that. But no, it's due September 15th, a month earlier than you think. But the last one is when you expect. The year ends on December 31st and you've got 2 weeks. That final payment for the year is due January 15th.
You talked about penalties a lot so far, but what about that cash flow piece? Earlier, you said that I could add extra onto my quarterly payments if I wanted to go beyond avoiding penalties, even out my cash flow, and avoid that tax bill on April 15th. How do I do that? Well, if you're using the current year method and paying in at least 100% of the amounts calculated, you're probably going to be pretty close. If you're using the look back method, you could use this rule of thumb. Look at your old tax returns and figure out what your tax rate has been historically as a percentage of your income. Multiply your current year income by that tax rate to get the amount of tax you want to cover.
Do I need a tax professional to help me with my quarterly estimated tax payments? Well, if you're using the prior year method, you probably don't. If you've got some tax software that you've been using to prepare your tax returns, they probably have a tool in there to calculate the tax payments that you would make using the prior year method, because the numbers for that are sitting right there in that tax preparation that the software has done for you. So the main reason you'd want to pull in a tax professional is if you have to use the current year method. Sometimes it can be hard to think through the numbers that you need to input. You have to do that complicated math of annualizing the numbers and then rolling them back. And furthermore, you need tax software to help you run all of those current year calculations. You also might take advantage of the time with your tax professional to do some tax planning. If you're already in conversation with them about how much you should pay for the year, it might be a good time to check in. Hey, have there been any new tax laws this year that apply to me? Or, gee, can you look at the last few tax returns that we've had and let me know if you think that we're missing anything? Or maybe you've got some life changes coming up and you want to discuss those with them. Birth, adoption, inheritance, all kinds of things that can impact your tax life.
The year's done. I'm looking back and I realized I may have messed up and not paid in enough at the right time. Is there anything my tax professional can do to save me from penalties while preparing the tax return, after the fact? Well, as I mentioned before, the penalties are based on the amount paid and the timing of the payments. There is a calculation your tax preparer can do using Form 2210 to reduce penalties if the timing of your income was uneven throughout the year. So let your tax preparer know if a large chunk of your income was generated later in the year. If it was, the estimated tax payment penalty calculation can be adjusted for that special timing. It's the middle of the year and I missed an estimated tax payment deadline. What do I do?
Well, as I mentioned before, estimated tax payment penalties are based on the amount and the timing. So if you missed a payment, just send it in as fast as you can. The sooner you pay it, the smaller your penalty will be. Now, there is another little provision that you might be able to take advantage of to save you if you've missed a payment deadline. There is a provision in the tax law that says that if you've had taxes withheld from earnings like wages, retirement plan distributions, Social Security income, unemployment benefits, anything like that, if you have taxes withheld from those, they are deemed to have been paid in at the correct time, regardless of when they were actually paid in, as long as they were paid in within the calendar year. So, how might you take advantage of this? Let's say you are an owner of a corporation. You get a paycheck from that corporation, but because you're an owner, you have a decent amount of control over how that payroll is run. So you could go into the payroll processor and say, hey, I need some extra taxes withheld for my paycheck for this paycheck or the next two or the rest of the year or what have you, to make up for the fact that you hadn't made your appropriate estimated tax payments throughout the year. Pretty cool trick, huh? Now, another thing you can do, maybe you're married to somebody who has control over the withholdings from their paycheck. So perhaps you are a sole proprietor or just an investor, somebody who has no opportunity to have taxes withheld from earnings because sole proprietors don't have withholdings from paychecks because they don't get paychecks. Typically, investors don't have taxes withheld from their earnings because it's just not done. So, but if you're married to somebody who does have control over the withholdings from their paycheck, you could have their withholdings help cover your taxes. As long as you're filing a joint tax return, all those tax payments are kind of thrown into the same bucket. So you could use your spouse's withholding of tax from their wages to cover your estimated tax payment bill. The last tool, well, it's kind of esoteric, and I only recommend it if you can pay really, really, really good attention to the details, because you can mess this one up big time. So here it is. When you roll over an IRA from one account to another, you can have taxes withheld from that rollover. So let's say, for example, you've got $100,000 in an IRA. You can designate at the time of filling out the paperwork to initiate the rollover, hey, I would like, say, $10,000 of this to be paid into the IRS. Typically, that is done by the IRA administrator because they don't know what you're going to do with those funds. It might be a taxable withdrawal. And if it was a taxable withdrawal, why, you'd want to have taxes paid in. But you're not making a taxable withdrawal. No, you are rolling those funds over into a new IRA account. So you are having the $10,000 of taxes withheld from that rollover and sent into the IRS. So now you have $90,000 to put into the new IRA account. And you're going to take $10,000 out of your own pocket and put it into that new IRA. So the new IRA has the $100,000 in it. Old IRA starts out $100,000. New IRA has $100,000. But meanwhile, you've tricked the system by getting $10,000 into the IRS's hands by having come out of your IRA and then replenished out of your own pocket. Now, I cannot emphasize this enough. You must roll over those funds from the old IRA into the new IRA within 60 days. Not just the $90,000, but also the $10,000 out of your own pocket. The entire amount must go back into the new IRA within 60 days. If you do not, you will be penalized big time. If you do not, you will pay tons of taxes. You must be very vigilant and get all of those funds the same amount you took out of the old IRA back into the new IRA within 60 days. Also, you are now only allowed to do one IRA rollover per year. So you can't just do this trick willy-nilly. I recommend only doing it at the very end of the year when you are assured you don't need to do IRA rollovers for other reasons. So because of this one rollover per year rule, you need to be very careful and only use this rollover trick when you know you don't need to roll over your IRAs for other reasons. So I just talked about some tricks for making up for missed estimated tax payments. Let me know in the comments below if you have any other tricks. I'd love to hear about them. I'd also love to hear in the comments what you got out of this video or any feedback you might have, questions. I'd love to be in conversation with you. Thanks so much for watching today, and we'll see you next time.